Well, we have seen some headlines that Canadian housing is overvalued to the tune of 60%. But as they say, valuation is in the eye of the beholder. One beholder I have with us is Craig Alexander, Chief Economist at TD Bank Group. Nice to see you.
It's a real pleasure.
Let's talk a bit about some of the headlines we've seen. 60% overvalued Canadian housing, true or false?
Well, we've seen many reports by various groups highlighting the question of, is there a housing bubble in Canada? Yeah. And the most extreme views, put the number at 50 or 60%. The issue, though, is how you assess overvaluation. And you can look at the market and assess it in a whole variety of different ways. Now, the really extreme views that are out there in terms of the amount of overvaluation are specifically looking at ratios of owning a house relative to the cost of renting.
Right.
And there's no question that home ownership costs have gone up a lot in recent years. Like the price of homes has increased dramatically. The problem with the comparison, though, is that when you're comparing owning to renting, renting is actually a regulated market. The landlords are generally not allowed to increase rents arbitrarily. In fact, in most jurisdictions, they're restricted to increasing rents. And this is one of the reasons why rent prices have only gone up about 2% a year over, like the last 10 years because of regulatory prices. So what you're really saying is you're comparing a market price for owning a house to a regulated price of renting. And quite frankly, if you look at the number of construction of rental properties, it's really been limited because it's been
get the return.
It's been much more profitable to build condos and then sell it to owners, and then they can rent out the properties. But in terms of actual just pure rental properties, you don't actually see many of them being built. So I would argue that particular ratio dramatically overstates the overvaluation in the marketplace.
Then what is the proper ratio that one should look at to understand if housing is a red flag?
Right. So so make no mistake, I do think there is overvaluation in the Canadian real estate market. I don't think we should be surprised that there's overvaluation when you have been through a period of exceptionally low interest rates for a very long period of time. Like low rates have made it much more attractive and affordable to own a house. So you would expect the market go maybe beyond its normal economic fundamental limits. So if we think about it and we say, well, owning versus renting is a bad comparison. What if you compared it to owning versus income? And you sometimes see this ratio used, and it would suggest that home prices could be overvalued by maybe 25 to 30%. Mm-hmm. But the metric of income being used often when you hear about a 25% overvaluation isn't including government transfers. It's not including income from other sources like investment income. So
I'm thinking, just to put this in layman's term, investment income, if you're older, drawing from your investments, that would not be included.
Or even, a family in their, sort of middle years that have accumulated wealth and actually have a lot of income coming into from their prior investments.
Got it.
Right? It's not counting, incest income from bonds. It's not including income from GICs. It's not including capital gains.
Yeah.
Right? So if you actually look at what I think is a proper metric of income, and you say, if we take all income and we look at it on an after-tax basis, so personal disposable income, and we say, okay, so if we look at the price of owning a house relative to personal disposable income, and we say how much higher are home prices today relative to their historical average, the answer is basically 8 to 10%. And I actually think that is a true and reasonable metric about the amount of overvaluation that's in the marketplace. I think the overvaluation is probably 10%. Now, I wouldn't be complacent about 10% because, quite frankly, it is telling you that there is some risk out there in the real estate market. If you had a sharp increase in interest rates or you had a sharp increase in unemployment, it could cause a correction. It probably would cause a correction in the housing market. And as we all know, markets don't unwind just the overvaluation. I mean, if you have something go wrong and the economy really, let's say the economy went into recession at this point.
It swings to the extreme.
Right. It could easily go from 10% overvalued to 10% undervalued very quickly. So
a 20% correction if that was the delta.
And I think this is what the Bank of Canada is signaling when it talks about risks in the Canadian housing market, that we can't be complacent that there is some risk out there. But understand, this is not a US style problem. So you can look at it owning versus renting, which I think is very distorted. You can look at it at owning versus income. which I do think actually, does provide some guidance. But none of that takes into account where interest rates are today and what affordability looks like. So we actually asked the question, if we actually look at what it costs to own a home, in terms of mortgage payments, utility bills, interest rates, at the current level of interest rates, is the market overvalued? And the answer is, if interest rates never moved from current levels, there's no overvaluation. The problem is the level of interest rates we have today probably can't be sustained indefinitely. At some point in the future, interest rates are going to go up. No, make no mistake, I've gotten sick and tired of telling people interest rates are going to go up and then they haven't gone up.
Yes.
So, we've been in this low for longer interest rate environment, but at some point rates are going to go up. And when that happens, there is going to be some overvaluation. So what we did was we said, what would happen if interest rates went back up towards more normal levels? If they went up, let's say, a couple of percentage points. And interestingly, we got the same sort of metric of overvaluation that we get relative to owning versus personal disposable income. So we get, basically looking at it a different way, we still get overvaluation in the 8 to 10% range.
For someone who's watching and listening to this right now, let's say that it is 8 to 10% overvalued. There is a correction. It swings back to the other extreme. What is the impact on the Canadian economy if Canadian housing prices nationally, and I know there's no such thing as a national real estate market, corrected to the tune of about 25%? What impact does that have on us spending, the economy as a whole?
Housing is the single greatest store of wealth for Canadian households. So if you had a very large correction in the Canadian housing market, that not only would it cause a drop in construction because the sector wouldn't be building more homes when they're not in demand. So that would act as a drag on GDP. And the construction sector is not a dominant share of the economy, but it's not an insignificant part of the economy. So weakness in construction would hurt the economy. But then you'd also have the impact on consumer confidence. You'd have a negative wealth effect. Canadians would likely feel that they need to save more because their house is now worth less. I don't think we would see the foreclosures that we saw in the United States for the simple reason that in Canada we have what's referred to as non-recourse mortgages. So if in the United States the value of your house fell below the value of your mortgage and now you owed the bank more than the house was worth, you could hand the keys back to the bank and say, I'm done.
Yeah.
Right? And the bank was the one that took the loss on the difference.
Not so here. In
Canada, in most jurisdictions, if your house drops in value and you owe more than the house is worth, let's say you have a mortgage of $150,000 and the house goes from being worth $200,000 to being worth $100,000. So net, the negative is $50,000. The bank would foreclose on the home, sell the home for $100,000, and then come to you and say, okay, now you still owe me the rest of the money.
Right.
And what that means is that Canadians actually have an incentive in a down market to still stay in their homes. Right? The odds are that you wouldn't get the degree of weakness that you had in the United States because of the structure of the market. But the other dimension to your question, like people often ask that, right? Like what would happen to the economy if you had a 25% decline in housing? And the thing I'd ask is, well, what caused it? Because if you tell me that the reason why the housing market corrected 25% was because of a sharp increase in interest rates, well, we've got more going on than just the housing market going down.
It's not in isolation, right?
Right. I mean, you'd have a big push on, you'd see a lot of pressure on debt financing costs for Canadians, right? And you'd see a big decline in consumer spending. Let's say the story was a hard landing in China that creates a global recession.
Softer commodity prices.
Prices. And then that leads to a recession in Canada, and that's caused by rising unemployment. Well, boy, there's a lot of other things going on in the economy, right? So the one thing you're not going to see is, one day we're not going to wake up and suddenly find the Canadian housing market has fallen by, 10%. Right? There's got to be something, a catalyst, to cause that change in behavior. And this is why I think the overvaluation is likely to be with us for some time, because is the housing market overvalued? Yes, the housing market's overvalued. Is there a catalyst to cause the market to have a severe correction? Well, as an economic forecaster, when I look at the odds of one of those events happening, if anything, the probability has gone down, right? We were worrying about a European financial crisis that could impact the global economy. We were worried about the US hitting the fiscal cliff. We were worrying about China having a hard landing. Well, you know what? On all these fronts, the actual risks of a global problem hitting Canada have actually decreased. And that means the odds of a correction in the housing market is low. As a result, there actually is time for the Canadian housing market to moderate and cool down. Now, it's actually going the wrong way right now. It's actually heating back up.
Well, I was going to say, because you also, I mean, from people I've spoken with, you know, there's no reason for interest rates to go up because that would need to harness the Canadian economy a bit. It doesn't need harnessing right now.
Right. I mean, rates, if anything, the Bank of Canada has signaled that interest rates are likely to be lower for longer. So as a result, you know, the odds of an interest rate shock is very, very low. The unemployment shock, I think, would come from outside of the country. It'd have to be something, for example, let's say, you know, the new worry this year is around emerging markets. So let's say in emerging markets, you had something that turned into a repeat of the Asian financial crisis of 97, 98. I don't think that's going to happen, but if it did, then that would hurt the global economy, and that could hurt the Canadian economy, and that could lead to a weaker Canadian economy and higher unemployment, and that, you know, in turn could hurt Canadian real estate. But again, I don't think it's the most likely scenario. The more likely scenario is that the Canadian economy is going to continue to grow at a relatively moderate rate. Interest rates are going to remain very, very low because inflation is very, very low.
Yeah.
That means the Canadian housing market is probably going to continue to be overvalued. The low interest rate environment is maintaining affordability. But I do think Canadians have got the message around moderating their debt growth, and we've seen personal debt growth slow. So I think that what we're likely to find is the housing market that recently has gotten a bit of a boost, that effect is probably going to wane. Last year, mortgage rates jumped in the middle of the year, and it pulled people that were sitting on the sidelines that might have bought this year into last year. Yeah. And the tightening of the mortgage insurance rules have, you know, abated, and when that happens, the market usually accelerates. So as we get farther away from those events, I think what we're going to find is the housing market in Canada is probably going to cool down a little bit. And then what we're looking for is low single-digit gains in both prices and sales over the next couple of years. I think the real test to the Canadian housing market is going to be when the Bank of Canada raises rates. And quite frankly, I don't think the Bank of Canada is going to be moving until the second half of 2015. And even then, it's not going to be the early interest rate increases that matter. It's going to be when interest rates get back up to more normal levels. And boy, that could be a 2016 or 2017 story. So there's actually room here for the Canadian housing market to soften. If the market keeps heating up, though, I think the government probably will have to take further action in terms of regulatory tightening.
Great talking to you, Craig. Thanks so much.
It was a pleasure.
Craig Alexander, Chief Economist at TD Bank Group. I'm Kim Parlee. Thanks for watching.